Insights on the bond market and the Fed. Let's bring in Kelsey Berro, the fixed income portfolio manager at JPMorgan Asset Management. Kelsey, great to have you with us.
Thanks for having me.
Have your expectations for cuts changed in the back half of the year? And do you think, a 50 basis point cut would be crazy?
So our expectations really haven't changed recently, even with the meeting yesterday and the press conference. Chair Powell, he wasn't willing to announce that they've achieved a soft landing, but honestly, I don't think he needs to. You can kind of see it. You can see it in the data, and you can see it in how the markets are behaving. We've had 25 months with unemployment below 4%. We have inflation coming down to 2%. We have the wage data, the employment cost index earlier this week, 3.5%. That's right on top of where the Fed views inflation to be sustainable. So a very good concoction of data. I agree, 50 basis points is not something I think is as a base case that they're expecting. How do you get 50 or 75 basis point rate cuts? You really need to see a weakening in the labor market data. Layoffs have been incredibly low on an aggregate level in the economy, and the unemployment rate has been very stable and very low. So to get that more aggressive rate cutting cycle, you're going to need to see it start to hit the real economy harder. But as Mike has mentioned, I was looking at a segment that you did yesterday. The market tends to not expect how aggressive rate cuts ultimately are in a cutting cycle. So essentially, the market underestimates
the impact or the size.
Underestimates the size of rate cuts in an easing cycle. So right now, the market's pricing the Fed to get to 3.5%, 3%, and just chill there.
Yeah.
That's a very optimistic view.
Yeah.
Could it happen? Maybe. But there's so many things going on in this world, it's hard to imagine that's actually where we end up.
I mean, what's your read on the way that long-term treasuries rallied so much and yields came down so much? At least it seems to be the case that the longer you wait for the first rate cut, things can happen in the interim and that make the economic situation a little bit less secure. And maybe we have the rising possibility of a mistake from the Fed waiting. So, you don't want to make too much of it. 10-year yields are right in the range they've been in for months. On the other hand, it was a pretty stark reaction to see yields going down, small cap stocks going down yesterday. We'll see if that shakes out differently today, I guess.
Yeah, I agree. I mean, it was a pretty strong reaction for ultimately something that most people are expecting. I mean, most people expect rate cuts this year. Most people didn't expect the rate cut to come in March. So the fact that 2-year yields were down 12 basis points, I think 10-year yields were down a similar amount, that was pretty surprising. But I don't think that I would fade that move until I see some of the upcoming data. So we have ISM manufacturing today, we have payrolls, and then we also have some data next week, very important, CPI revisions, and also the Senior Loan Officer Opinion Survey, which asks the banks about credit tightening. With the headlines about New York Community Bank right now, that's something that I would be watching to try to indicate, is this a one-off? Or is there more concern? Now, we do think that this is more of a company-specific issue, but that's a place where you can really dig your teeth into that and get confirmation.
It's funny because I was looking through the transcript of New York Community Bank, and it did seem very sort of specific, idiosyncratic.
Incredibly specific.
There, right?
And they made these acquisitions. They went to a new $100 billion asset threshold. They have a really not very common portfolio of New York City multifamily and office.
Co-op loan.
Yeah.
And
so anyway,
and that
being the case.
Yeah. But in terms of, the rate cuts, we need to see 2%. We need to see the path to 2%. And there is that risk that, the low-hanging fruits of disinflation, we've picked them, we've harvested them, and now it's just the much harder part of this cycle. Do you think there's a risk that markets are getting a little bit too giddy, thinking that inflation will actually come down toward that 2% enough for the Fed to feel conviction to cut, and that the risk could actually be that we stay higher for longer?
So there is a risk that we are not talking about right now, which is the reacceleration risk. The risk that inflation, its 6-month run rate right now on core PCE is 1.9%, but it picks back up. We view that as a fairly lower probability than the two more realistic scenarios. We think there are 3 essentially scenarios that we're thinking about for the bond market right now. 2 of them being very positive for high quality fixed income. One of them, soft landing continues. It's what we're experiencing right now. The Fed delivers gradual cuts. If you lock in high quality fixed income yields right now at 5 to 6%, you're getting essentially your carry. The second most likely scenario is that this all ends in recession like it normally does. That's not our base case, but we know that the Fed is not very good at engineering a soft landing. There are risks to the economy. In that case, the Fed delivers a lot more rate cuts than we expect. You get that carry, but you also get capital appreciation. The third scenario, the lowest probability scenario, is that reacceleration risk, which I think both equity and bond markets are not prepared for right now.